I've shared with you in the past that I'm involved in a Goldman Sachs program called 10,000 Small Businesses, and it's designed to help me grow my business. So when I saw this morning on Squawk Box Christian Gussman from Goldman Sachs explaining his year-end strategy, or Goldman Sachs's year-end strategy for investing in the current economy, my ears peaked up, and I said, I need to share this with my tribe because I think it aligns quite well with what my strategy is for the end of the year. And so let me take you and share with you a clip from the video that was on CNBC by Christian Gussman from Goldman Sachs and their year-end strategy.
What we found is if equities in a 6 or 12-month horizon go up as much as they did just in the last 6 to 12 months, it's usually because of a macro backdrop that is very strong. And such a strong macro backdrop doesn't disappear in a matter of a few weeks and months. Like it requires a bit more warning signals, and especially with the labor market data starting to look a bit more healthy again, we're currently not having these warning signals. So that's kind of why we're happy to buy the dips. And I think in terms of sectors and themes, I think we're certainly kind of generally, because of our somewhat late cycle position, we're leaning in two areas. Quality growth that gets punished for whatever reason, but in the long run is attractive and can kind of see valuation expansion. And then you pick selective kind of cyclical value laggards that might have suffered significantly because of macro not being as friendly. So that's our strategy going into year end.
Now, I want to emphasize that those stocks that appeared, such as Amazon, Google, Microsoft, and Meta, that those are my growth stocks that I feel are going to take me into the new era of AI and semiconductors and data, and are going to grow at the rate that they have grown in the preceding 20 years, which is to give me a rate of return of roughly 25 and maybe even 45% over the next 5 years. I would add to that category Apple, Nvidia, Tesla, and TSM, Taiwan Semiconductor. On the other side, when he is talking about depressed stocks that for one reason or another are not growing the way they are and have given me an opportunity to buy in a dip, would include the AEHR, which is Air Test System, ASML, Micron, and Navitas. Now, I would also add to those Dell, ACMR, GTLS, and Vertiv and Modine and several others. And what I want to do is, I think where I'll end up is that 60% of my stocks or my holdings are going to be in this growth category of the big players, the essential players in the growth of AI and semiconductors as we move forward. And on the depressed side, I'll be somewhere between 35 and 40%, because I think these are stocks, because they have been depressed, because they have fallen out of favor, because Mr. Wall Street has not blessed them, they are going to give me greater potential growth. Now, the other thing I'm going to do is minimize risk. I have some stocks in my portfolio now that are I consider moonshots, in that if all things fall into place, they will give me even greater returns. I'm kind of backing off of those and saying, let's don't be greedy. If I can take the growth stocks and the depressed stocks and split them 60-40 and come up with a annualized return in excess of 40%, that's enough. That's really enough, because I don't want to take on the risk. I got hung up on that in the genome sequencing stocks of the past, and I don't care to go there anymore, because there are extenuating circumstances that keep them from performing. Oh, I believe genome sequencing will change this earth. I believe that the works of stocks like CRISPR and some of the others that Caribou and Editus, they'll change the world. But I don't know if I'll live to see it, because there are governmental regulations, there are insurance considerations that are going to play on that. Now, there's other areas, of course, that I could get involved in, and that is energy and different the electricity that is going to be needed in the data centers and things of that nature. But I don't study those. I try to be a neurosurgeon of the semiconductor and the AI world. So to say, okay, I want to get involved in energy as well because that's going to come into play. Well, I can't do all that. So I choose not to. And I would advise you to choose not to. The other thing that came to light of late is I've been talking to a number of college students and young people who have come to me and say, I want to learn how to trade stocks. No, you don't. You do not want to learn to trade stocks unless that is going to become your profession. No, what you want to do is learn how to invest in stocks, and you get associated with someone who has vision as to what is going to happen. And I believe I'm that person that knows semiconductors, that knows artificial intelligence, that knows that Amazon, Google, Microsoft, and Meta have spent close to $2 trillion on their data centers and the GPUs and the servers that are going in there. And if they're spending that kind of money, then they know there's a growth opportunity that is going to pay off on the future. So don't make it any more complicated than it needs to be. If you're young and you've got a Roth IRA and you're funding it, put on your forehead, Amazon, Google, Microsoft, and Meta, $2 trillion investing in the future. So just follow the damn money. That's where it's going. That's where you want to be. Is it seasonal? No, it's just going to come like a train and be a part of it. Now, as I say, you might want to consider Apple. You certainly want to consider NVIDIA, but also understand NVIDIA is the company that's building the infrastructure to make AI possible. Once the infrastructure is built, yeah, you may have to update it, but you aren't going to get Amazon, Google, and Microsoft and Meta to spend another $2 trillion. Once they spend their $2 trillion, yeah, they may update them, but it isn't going to be $2 trillion. It might be $2 billion a year, but the big money is being spent up front. And then the big money is going to be made delivering AI to you and I. So, along with Goldman Sachs and Christian, I have a year end and beyond plan. Invest in the growth stocks that are spending the money on the growth opportunities that they see in front of them, and then augment that or accent it with some depressed stocks that will give you exponential growth, but also know when to get out of them. When is the time to get out of AEHR? When they've done their surge and now they're just another company producing income. Their growth will be growth, and then they'll settle into a pattern. That's the time you want to move out and find the next growth opportunity. Focus on that word, growth opportunity. Businesses are in businesses to generate profits. Profits turn into earnings per share. Once those earnings per share start to settle, the growth opportunity is over. So you need to recognize when is it happening and look for companies that are funding growth opportunities, hiring people to make them happen, and then providing you surge. But the mainstay of your portfolio has to be the big tech that are spending the money to get their growth opportunities so they stay the big tech. Okay, I'm Kerry Grinkmeyer. I hope you appreciate the words of wisdom that Christian Gussman gave you and I on what the biggest investment firm in the world is doing for the rest of the year, and maybe you ought to follow suit. Kerry Grinkmeyer, past financial advisor that puts together a tribe, and we're following the wave. Talk to you again soon.